Welcome to Caribbean Business Review, where insight meets impact. We bring you economic and financial updates, sharp statistical breakdowns, and data-driven insights on the forces shaping the region. Smart analysis, bold ideas, real Caribbean intelligence. This is CBR. Hello everybody and welcome. This is Caribbean Business Review. My name is Joseph Cox. And this week, as we go on to our 8th program in this series, we are going to be looking quite a bit at the power transition. And that is really the power transition and what is going on in terms of the transformation of our electric utilities right across this region. Of course, this conversation has been triggered by the recent announcement by the government of Jamaica for non-renewal of the existing license with the Jamaica Public Service Company, the monopoly electricity provider. We'll be having that discussion with Dr. Devon Gardner, who is quite knowledgeable on these matters, who will be guiding us through this conversation. We'll also be having, of course, our CBR briefing, where we're looking at the whole matter of what we call the pink tax, which is a gendered issue that we have to really look at in this region because it's gendered pricing. And it's quite eye-opening when you hear some of the data that obtains with that. So we invite you to look at that, to listen to that one and follow us for that, follow up on this program today with that discussion. But I wanted to also raise a couple of issues. One, this new G7 agreement, if you will, whereby the U.S. multinationals are no longer being guided by the global minimum tax. Now, if one would recall that for many years, this region has been put under stress, or institutions have been put under stress with the threats of blacklisting. You had, of course, the obvious reputational damage and the de-risking by the global banks. All of this, we were all told at the time, this is really to ensure that there's a level playing field and there's no race to the bottom. Now, the U.S. is out of it, right? Basically on their own terms, they have to do what they wish, as it were. And now we are faced with a situation within this region where we are at a distinct disadvantage, a competitive disadvantage, where we could have situations of company relocations to the United States, etc., which is not what this entire process was about. So our region was bullied into engaging in a particular type of action. And now all of a sudden, the main player is no longer impacted by it. What this really says to us, ladies and gentlemen, is that we need to be looking at, frankly, looking more to the UN system rather than the OECD for any kind of guidance where these things are concerned. Where at the UN, at least the region, the Caribbean, and indeed wider small island development states will have a seat at the table, and there will be far more equity in this process. But anyway, on a bit of good news now, Bermuda has gotten G+. They have a transition to 5G+, or will be transitioning to 5G+. Now, the reality of life is what makes this particularly interesting is that for many years, our telecommunications providers throughout the rest of the region have been advancing the argument that there is no business case for the rollout of 5G in this region. And they've come up with all sorts of conversations about justifying why it is. Now, when you look at the size of Bermuda, the population there too, etc., how is it that there is a business case, a viable business case? Because surely the provider is not going in there to lose money. So how is there a business case for that? But there is no business case for the rest of the region. Something is very wrong. And while our heads of government, within CARICOM at least, they meet to deliberate over the course of the next couple of days, one would hope that this issue of the telecommunications transformation really comes front and center, because we have been lagging for many years. And with the advent of AI, we do not have that luxury of time anymore. So that's what we have to be doing. So, ladies and gentlemen, all in all, we'll be hoping to have a packed program for you. whereby aside from our interviews and commentary, we do have our Market Watch and our Global Pulse segments, which are the news segments, where we bring you up to date on what's happening regionally and internationally, and those which might well impact us, or at least should be guiding our policy development and structures as we move forward. So all in all, we do hope that you will enjoy this program, and we'll come back to you indeed just after the break with the CBR briefing. So until then, this is CBR. Welcome to the CBR briefing. I'm Joseph Cox. In our economies where cost of living is already high and inflationary pressures remain stubbornly embedded, we confront a quiet and persistent form of economic inequality that rarely makes headlines, but perhaps it should. It's called the pink tax, and if you have never heard of it, chances are you have paid it or know someone who has. The pink tax refers to the consistent pattern of higher prices charged for products and services marketed to women, from toiletries to toys, from personal care to financial products. Crucially, it's not a formal tax, it's a market practice. And while most of the global data on this issue comes from large developed economies, its relevance to the Caribbean is far from abstract. Why? Because Caribbean economies are deeply integrated with global supply chains. We import 60 to 90% of what we consume, and that includes fast-moving consumer goods, personal care items, pharmaceuticals, apparel, and even digital services. So when a razor produced and priced for the US or European market enters our shelves, complete with its gendered markup, that pricing gets passed along wholesale. There is no local offset, no Caribbean discount. Now let's talk about the data. A landmark study by the New York City Department of Consumer Affairs in 2015 reviewed nearly 800 products and found that women's items cost more 42% of the time. For personal care items alone, women paid on average 13% more than men. A 2021 UK Parliament report found similar trends, with women paying significantly more for items like deodorants, razors, and even in the child toys section, where pink-colored versions often came at a premium. Retailers often justify the markup by citing product differentiation, marketing costs, or assumed purchasing behavior. The truth is more uncomfortable. There's an embedded commercial bias that assumes women are more willing to pay for perceived value, even when the value is purely cosmetic. Indeed, let's be absolutely clear. The price disparities are not tied to production costs. A blue and pink razor typically have the same blade count, plastic composition, and shelf life. The only difference? Packaging, labeling, and perceived gender targeting. When we examine this issue in the Caribbean context, the implications are stark. First, women in the region already face economic headwinds. They are overrepresented in informal work, part-time jobs, and in caregiving roles that often go unpaid or underpaid. Female-headed households, particularly single mothers, make up a large share of the most economically vulnerable. So when the cost of essential goods for women is consistently higher, it effectively becomes a gendered penalty on consumption. Second, our regulatory environment offers limited protection against this type of pricing bias. Consumer protection agencies exist in most Caribbean countries, but enforcement mechanisms are typically geared towards fraud or substandard goods, not pricing inequity. There is no law in Barbados or Jamaica or Trinidad, among others, that says a company can't charge more for a product just because it's pink. Third, the ripple effects extend to services too. Hair salons and barber shops across the region routinely charge higher prices for women, even when the service performed is the same or less complex. Dry cleaning is another common example. Women's clothing is often subject to special care surcharges, while men's shirts are washed and pressed at a standard lower rate. While most regional banks no longer explicitly price credit differently by gender, anecdotal reports suggest that women borrowers, especially entrepreneurs, may still face disparities in access or terms, particularly when informal collateral or spousal guarantees are introduced into the equation. Some may argue these differences reflect real distinction in service delivery, and sometimes that's true. But more often than not, it's a default practice with little grounding in cost structure and everything to do with gender based assumptions. So, what can be done? At the policy level, Caribbean governments could take a cue from international examples. In 2020, California passed a law banning gender based price discrimination in services. France has imposed restrictions on gendered pricing in retail. Here at home, consumer affairs agencies could be empowered to conduct pricing audits, especially in supermarkets, pharmacies, and service sectors where price gaps are most entrenched. From a business perspective, retailers can take voluntary steps, conduct internal audits, neutralize branding, or create gender inclusive pricing standards. Companies that position themselves as progressive or community minded should consider whether they are knowingly or unknowingly penalizing their female customers. But ultimately, awareness is key. Consumers, especially women, need to be empowered to question price differences compared across gendered sections and challenge unfair markups. Because in the Caribbean, where every dollar stretches just a little less, these invisible surcharges are not just unfair, they are regressive. They deepen inequality, penalize economic agencies, and chip away at the hard-won gains in gender equity. So the next time you're shopping and you see two identical items, one pink, one blue, and the pink one costs more, know this, it's not just a pricing decision, it's a statement. And it's one that we can and should push back against. Now, this is the CBR Briefing. I'm Joseph Cox. Join us next time as we continue to explore the economic undercurrents shaping life across the Caribbean.
In a world of constant change, insight is your greatest asset. At Joseph Cox & Associates, we empower innovation across the Caribbean. Whatever your challenge, we can help. We're proudly customer-centric, offering bespoke solutions tailored to every partner. From innovation and digital transformation to leadership and policy, our services are designed to deliver lasting impact. We partner with leaders across sectors, from finance and government to energy, tech, and infrastructure, helping them navigate complexity with confidence. Our work is grounded in collaboration. We connect regional leaders through powerful networks, driving change through joint research. Discover more at josephcox.org. Joseph Cox & Associates. Insight, experience, impact.
Welcome back to Caribbean Business Review. I'm Joseph Cox, and today my special guest is Dr. Devon Gardner, who is a senior partner at the Institute for Innovation and Growth. Now, today we are going to be having a conversation about basically power transitions within this region. Indeed, to frame our discussion today, one would be very mindful of the fact that the government of Jamaica has announced that it will not be renewing the license held by the utility or the power monopoly, the electricity monopoly, Jamaica Public Service Company, when it expires in 2027. But the fact of life is that in the interim, the number of imponderables are there, because whereas the government has indicated it might be looking to negotiate or renegotiate with new players, basically, I don't know that the door is completely closed on the current provider. But at the same time, there are some issues that we have to explore as to whether or not, what are some of the challenges that are likely to obtain. What is the regional experience been so far? We are mindful of some stuff that has happened in Barbados, in Belize, and indeed you have some other arrangements that are occurring in several other of the islands. So, Devon, as I welcome you to the program, my question I suppose fundamental question is, from your perspective, what are the real implications of the government of Jamaica indicating at this stage, I suppose this was its statutory duty, but indicating at this stage that it will not be renewing the license? What does this mean legally, institutionally, and frankly speaking, politically, as you look at the changing dynamic?
Yeah, thanks, Joseph, and good day to all the listeners and viewers. So, really, the government had three options before when it comes to the license. Option one is you renew the existing licenses, and we continue with the status quo. Option two is you seek to negotiate terms and conditions with the existing utility with JPS and seek to do the renewal but with modifications to the terms and existing terms and conditions. And option three is what the government has chosen, which is to pretty much indicate that it will not renew the license. So the option three of not renewing the license allows the government now to design and license from scratch and to determine whether to negotiate that new license with JPS or other players. So that is really what is ensuing. Now, the reason why the government has taken option three is that the existing license is 20 odd years old, over 25. It's flawed. It's about 25 years old. It's 2001 license. In 2001, Jamaica had very little renewables in the system. What we could consider renewables which Jamaica had in the power system to be marginal in 2001. It had like very small hydro, 5 megawatt hydros, 2 or 3 of those, and small 200 kilowatt turbines in Monroe. Fast forward to 2025, Jamaica has significant amount of wind. 3 phases of Wigton and BMR wind farms, and then it also has 2 major solar utility scale solar facility, and it's now in the process of negotiating 2 additional large scale solar facilities, and is going to be auctioning very soon much more solar facilities, not to mention what is existing on the distributed side of the system, which is like rooftop PV and that kind of thing. So the landscape has changed significantly in terms of how energy is being generated within Jamaica. And if you look at the way the power system operates in respect to what technology allows people to do, customers to do, as well as generators or independent power producers to do in terms of how they interact with the JPS grid. It's a much more dynamic field of play. That's why Jamaica has shifted from, least cost expansion planning to generation expansion planning to where they are now with integrated resource planning. That way, they capture the myriad of what you call players who are actively engaged in the production and use of power. Of course, JPS in the middle still have the license as the sole transmitter and distributor and seller. So there are a lot of things. Even on the distribution side, there are many operators on the distribution side who could probably distribute and sell electricity more efficiently and more cost effectively than JPS. But the license doesn't allow them to do that. So there are people who are operating on the distribution side and doing leasing of equipment, solar PV, battery energy storage, and those kind of things to large customers. And because the prohibition of sale doesn't allow them to sell, so what they do is they pretty much design and build solar and rooftop or ground-mounted solar system and battery storage and other enablers of electricity production and consumption. So these are treated as self-consumption projects. So you're really constrained by the fact that you can only do self-consumption projects. The financing is what you are really, in a sense, allowed to be flexible on. So the changes which have ensued in the last 25 years in terms of technologies overall globally, in terms of the paradigm shifting thinking regarding how the power sector should be operating to facilitate sustainable development, growth, and climate resilience. The way in which we see different players and different stakeholders emerge in articulating and demanding how they want to participate in the power sector is requiring us to really take a deep, hard look at the licenses of operators across the region and to determine whether or not the existing licenses are really serving the purpose of the sector and the purpose of those who it is intending to serve, which is the customers ultimately. So that is really why I think that the decision that Jamaica has took to say, let's just get rid of this, just get rid of the on the table and just build something anew. Sometimes when you have a property with a house on it, and you look at the house, and when you start thinking of what would be required to reconstruct that house or rehabilitate that house to make it the way you want it, you realize it makes no sense. It's better to just knock down the whole thing and start building from scratch where you have better.
I hear you on that, but you see, part of the challenge with it, and I'm glad you raised the issue of the energy mix, because clearly that is something that we have. As you move forward, you would in any country you have to be looking at. But one of the challenges two challenges, one that I see coming up, dependent on how this actual exiting from the contract or from the non-renewal of the license is handling. One, if it is handled badly, it could end up in a legal process, in arbitration. But the other question, or the other aspect of it, is that with the flawed distribution system that you have now, and the line losses is one aspect of it, but the theft that obtains, in terms of any new player, any negotiation that is going to be, I would presume would have commenced already. How much effective latitude do you really have, one, in terms of the negotiation, and two, when you are looking at something of this nature, what happens in the interim? Is it that JPS could stop investing now? God forbid there is a hurricane that goes into Jamaica, does that, they lay down arms? What happens now?
So let me start with the last question first.
Okay.
The license continues until July 2027. JPS therefore has obligations that it must meet until the expiration of its license. So JPS cannot down tools and say, look, our license it will not be renewed, and therefore we don't care about how we take you to the end of the road, which is until the end of the existing license period. There are obligations that JPS has under the existing license that they must fulfill. Otherwise, any arbitration, as you say, or any kind of litigation would be against JPS and not done by JPS. So they have obligations that they must meet, and the OUR is there to ensure that the licensee meets its obligations under the license for the remainder of the license. And that's going to be important, that the OUR, which is the Office of Utility Regulations, which is the regulator in Jamaica, pays attention to that, ensuring that the quality of service and the cost of service is properly managed as JPS exits the fray. And as you rightly say, that doesn't necessarily mean that JPS will exit the fray. I mean, the fact is, as I said in the beginning, JPS will, as identity, perhaps continue with its generation service. JPS has an IPP subsidiary, which is Southern Jamaica Power Company, that does generation. JPS might decide it wants to continue to do generation, and it remains as an IPP, and continues to bid for additional generation opportunities when those arise, and continue to play part of the Jamaica power sector generation landscape. It may exit the grid service aspect of the sector, or it may actually be able to put enough on the table to the Jamaican government when the new license emerges, and actually win over the favor of the government with respect to that new license. But interestingly, that new license would obviously require JPS to operate in a different way. It may mean different ownership, different management structures. So the new license does not mean JPS is gone. It's just that the way in which JPS is doing things under the current paradigm is going to obviously shift. So there is nothing on the table at the moment to suggest that JPS is going to simply pick up its marbles and walk away. So the idea that come 2027, JPS is going to be leaving and not therefore be interested in continuing to operate within Jamaica, and will already start to figure out how to pack up its bags and go, even as we work towards the negotiation of a new license, is not necessarily the case. So JPS has existing obligations, and there are opportunities for JPS to continue playing in the sector, whether as a vertically integrated utility or as an IPP generator. So those are things that will happen. Now, I agree with you in terms of the first point raised, in that there are some key reforms that need to be placed on the table and dealt with, and one of those really is the matter of losses, theft, as you referred to it as, and that solution requires a political solution. The point is that there are some parts of the losses that JPS must take responsibility for, and there are other aspects of the losses that JPS must also take. That the government and opposition will have to assist JPS, or whoever it is that is going to inherit the license to solve, because there are parts of it which are socio-political, and we know some of this is with theft. But there is also another piece which is really related to how the license is structured to allow for the types of punitive measures that will discourage theft, because those who know who have been examining the data, even though a lot of it is not necessarily publicly available, but those who have been examining the data and the losses know that the communities that we typically finger in our conversations are not responsible for the majority of the losses or the majority of the theft. A majority of the theft is really coming from those who are bypassing meters, who are bypassing the meters. Not from the trope lines, So there's a bigger issue there, and that would require really serious legislative changes that would allow the law to go after those who are caught and penalize them severely.
But doesn't the law do that now?
The law do that.
Fair.
The law did that, but the penalties are not sufficiently severe to discourage it. So, there are many things that the law do, but the law is not sufficiently robust to discourage it, So if the law is going to give you a fine of 100,000 and you are saving $2 million a year, I'm not saying those are the numbers, but, just speaking anecdotally, then there's not the incentive for you to stop it, is not there, because if you get caught, what you lose by paying a fine is nothing compared to what you gain from the savings. So yeah, it's a major issue. There are also some other issues which would have to be put on the table. And I've listened to Philip Powell, I've listened to Darrell Voss, and I've listened also to some of the independent power producers and private sector participants in the sector. But there seem to be a consensus that this is a good move, and I also agree that it's a good move. When the price of electricity is hitting 51 US cents per kilowatt hour in Jamaica, and considering the kinds of options that Jamaica has to generate power, it makes no sense, especially when fuel surcharges, which are passed on to customers, is a big part of that. JPS has what we call a right of first refusal, or a ROFA in its license for the existing generators that it has in its fleet. JPS has never replaced one of its existing thermal generators with a renewable generator. As a case in point, even though the utility regulator has already given it permission to do so. So it kind of gives you which is one of the reasons why people, the saying is out there that JPS is not really interested in renewables, because you would think that if you have the right to first refusal to replace your existing generators when they get to their end of life, you would be already seeking to see how you could integrate new modern renewable technologies which are insulated against fuel prices, external fuel prices, in some of these ROFA arrangements, but you're not seeing that kind of shift, and it's not nearly coming as fast as it should. So that just is a case in point that I want to place out there so people to understand. So you have this capacity of generators in the country which are ring fenced for JPS, and those are you cannot be touched by anyone else, because they have the right of first refusal to replace that generation. And if those are not going to be replaced by renewables, then that kind of limits how much renewables the government could bring into the grid. And the JPS generators is a significant amount of the generators that is in the system. So it makes sense.
No, I understand that, but you see, one of the things that I always recall is that some years ago, the OUR had indicated through when they were doing some prep work regarding electric vehicles, that if 1% of the vehicles that we actually imported into Jamaica were electric, that the grid would have collapsed. The grid could not accommodate. No, the question therefore would be, for the Jamaica to move forward, what sort of lead time would a new provider, if it comes to that, how much lead time would they need to actually strengthen the grid, strengthen the capacity for it to really make a meaningful difference? And I mean, from a political standpoint, are the people likely to have the kind of appetite to wait on any kind of learning curve that is going to emanate?
Yeah, thanks for that question. Well, I agree with you that one of the challenges that people have had, and I mean, even in the post-burial, in certain sections of the island, there were certain parts of the infrastructure which went down, and people were annoyed because some of the infrastructure which went down was infrastructure that were, if you want to call them, at risk of failure for a while, and people recognized them as actual points of vulnerability in the grid, and had pointed them out many, many years ago, and there was limited action taken on those. If you look at how the generation is set up in the region, especially in terms of in the country, in terms of the renewables, most of the renewables is on the south, and most of the load is on the north. So there are some conversations around that need to take place around where to build some of the major substations and how to strengthen some of the assets in the areas where you have the major generators, so that you have lower risk of failures in those areas, and better redundancy. So what is needed to be done on the grid, there is a lot of studies and a lot of understanding in terms of what is required for making the grid more robust. The question is really going to be about how you get in an investor to run the utility. Whether it's the utility is a grid service operator or a vertically integrated utility is another story. But there will need to be that kind of conversation around what type of investor you require. For you to make those kind of changes to the grid, you really need an investor who is in it for the long haul. Now, there are questions around whether the owners of JPS, at least the two foreign owners, were in it for the long haul. There have been conversations around, around for a while, stating that they were looking for sales for JPS. So there have been very few. There have been quite a few people who feel that they were looking more for short-term returns and not so keen on investing in many of the longer-term projects, which is one of the reasons why some of the investments in the grid have not taken place. You kind of need those investments or investors that are in it for the long haul, so that you can amortize the investments in some of the grid assets over the long term, so that the ratepayers are not going to have to front load the cost of that investment. Because if ratepayers have to front load it, you understand what that would mean in terms of the rates, which are already high.
Of course.
It's an opportunity to really sit down, craft the license how it wants it, and then to find the type of investor or investors that suit what it is that we need to deliver under the new license.
So, but Devon, let me ask you this. So therefore, if you were advising government, and I'm going to broaden it to the region in a few seconds, but if you are advising government of Jamaica, would you be looking to a concession licensing regime, a performance regime, or a modular regime? Which one would you think would work?
I mean, at this stage, my personal leaning would be to disaggregation of the existing license. I would, not as extreme as Barbados, but something which disaggregates generation from the system operation is one that I think would make good sense, especially given what's happening in Jamaica now in terms of the amount of renewable opportunities which there are, and the opportunities to issue generation license to multiple players in a generation licensing system. You would have to now find ways and means of making it sufficiently attractive for an entity that would operate the grid system under a license. Whether or not one of the generators would be allowed, with an entity which holds a generation license would be also allowed to hold a transmission and distribution license is another matter. But there would definitely, the disaggregation of the license should be something that's high in the conversation, in my view. And of course, within that context, looking at performance based regulations to support the operation of that license. The licensee is something that we always believe is good. We think performance-based regulations is good for the customer and it's good for the utility. You do well, you get rewarded. And if the utility does well, the customer benefits. So performance-based regulations would need to accompany the license. So obviously, with whatever license is emerging from the redesign, obviously the regulations would have to be reviewed, dated to match whatever terms and conditions are emerging in the license, so that there is no dogleg between what the licensor can do and what the regulations are telling you can't and can do. So that regulatory reform has to come, pretty much right behind in lockstep with the license update that is emerging. So the two things have to work hand in hand in a sense. So the one thing
let's be practical. But let's be practical. Sorry, but let's be practical, because one, we all know throughout this region, and this is where I want to broaden it to bring in the other countries or some of the other countries. We know how long it takes for legislative reform. Between the so-called consultation processes that occur, then the various agencies have to get into it to craft the actual language, etc., plus going through the parliamentary process, etc. So one is basically 2 years. Is 2 years sufficient for that sort of work, or has it already commenced, for example,
I was about to say, in
Jamaica?
the case of Jamaica, the work has already started. So we're not starting from
Oh,
scratch.
I see. Okay.
Yeah, so
Okay.
Yeah, so
But all right.
Yeah,
No, fair,
yeah,
fair enough, and I'm glad to hear that.
yeah.
But the other thing then is that when you're looking at something like that, what can we learn from some of the other countries? So, for example, Belize, they nationalized their situation because they're having, I mean, seriously regular power supply, a lot of blackouts, etc., etc. Barbados has taken, I think, majority position in the electricity company there. You have places like St. Kitts and so on, who they are using different types of solutions, but it's working in tandem with the current supply. I'm curious. Are there any lessons to learn from that? I mean, government of Jamaica is clear. They said they're not nationalizing it,
Yeah.
even though they have a
Actually,
19%
yeah,
stake,
yeah.
but they
Mhm.
said they're not nationalizing it.
Yeah.
Are there any lessons to be learned?
The question of nationalizing is one that I think there are lots of lessons in terms of what not to do that we could learn. I mean, the countries that have nationalized, which is Belize and Guyana, in a sense, and now Grenada most recently, they haven't made improvements. In the case of Belize had nationalized, but Fortis still ended up having some shares in it anyway. And even though it's nationalized, one could argue that BL is somewhat captive to Fortis, even in its nationalized state. So
But when they nationalized it in Belize, it forced arbitrations. It wasn't a tidy setup at all.
it forced arbitration. In the case of Grenada, it was nationalized through a directive from arbitration. You would recall. So, so nationalization. In this instance, it would have been different because Jamaica would not be acting against the run of the license duration. In the case of Belize, the license, there was a license that the utility had when the utility was nationalized. So you would have nationalized while there was an existing license in play. Likewise, that would have been what happened in Grenada, in the sense that in Grenada, there were changes to the license while the license was in play that the utility didn't agree to, and the utility took the government to arbitration, and the decision was made between the utility and the government during arbitration that the government will buy the utility from the private sector investor. So those are different instances. In the case of Jamaica, the license is coming to an end. The government has signaled that it will not renew the license. So if at the end of the license the government were to then that would not require arbitration because it's at the end of the license. But what would be required is obviously looking at the assets and looking at fair price for the assets in respect to the transfer of assets to whoever becomes the new system operator and the new owner of the utility assets. So it's really going to be more a matter of a transactional arrangement that would look at fair value and fair price for the assets. Where the utility would probably put its cost to what it thinks the asset is. Government would look at it and do its own audit and come up with its own price. And then somewhere in the middle, they would have to meet to determine what would be the common price that they would agree to. Yeah. But in the case of Barbados and some of the others, and St. Kitts and some of the others, in terms of how their utility sector transformation and reform is going, I would say Jamaica is way ahead of the majority of them. I mean, Barbados on paper has disaggregated its utility sector license, and it's still continuing to figure out how to stand this up to make it effective. But it has, operationally, there's a lot that they still haven't figured out yet. So on paper, Barbados is quite advanced in terms of its disaggregation of its electricity licenses. But, many of those licenses to date, even the license for battery storage, licenses for, distribution and all of those licenses, because they have chopped up the license into generation, transmission and distribution, storage, and all and all of these things. So there are different, completely different licenses for the various stages within the operation of the utility and of the utility business, and they haven't yet figured out exactly how to really operationalize, even though in law it exists, and they are still working through those nuances. And in the case of places like St. Kitts and Nevis, places like St. Vincent and so on, where the utilities remain nationalized, they are struggling. I mean, in fact, recently we were doing some work with the World Bank, and not the World Bank, sorry, with the Caribbean Development Bank. I was doing some work with the Caribbean Development Bank, and one of the things which emerged, interestingly, is that a majority of the utilities which are nationalized, we have gone through all of the utilities, looking at their, how they are set up. The majority of the utilities that are nationalized in the region are not creditworthy. They have poor creditworthiness. The ones which are JPS are the privately held ones are among the most creditworthy utilities. These are the utilities that tomorrow morning can issue a PPA against their balance sheet without problem. Utilities like Lucelec and JPS and BL&T. And most of the others which have deep public ownership, they are not even worth the PPA on which the paper on which the PPA is written. The PPA being a power purchase agreement. So that's why oftentimes even in some of those countries, when it's time for, when private sector investors wants to put new generation, whether renewable generation and so on, into the mix, and even though there are good intentions sometimes by the government and the utilities to accommodate it, it can't be accommodated because a utility that's not creditworthy then requires the government to issue a sovereign guarantee to back the PPA. And in many of these countries, you know the situation. So these projects are non-starters for that reason. So the creditworthiness of utilities in the region is actually a huge problem. And Jamaica is fortunate not to have that problem. So we need to make sure, that we don't lose in terms of that value of having a creditworthy utility.
That's a very interesting point to make. And it really segues really into the issue of when we're looking at the future, frankly, for this region is that, and for the world, is that artificial intelligence is the future. One of the downsides, I suppose, from artificial intelligence is that it requires immense power supply. You have to up your power supply to meet those sorts of requirements. From where you sit, Devon, you obviously are well read and experienced right across the region. Is this region ready for that? I mean, what is the kind of lead time that one would realistically need to bring the region up to the stage where we can actually start to play in that space, the AI space, in any meaningful way?
Well, I mean, in terms of the energy side of it,
it's energy.
The energy side of it, the region, I don't think the region has a problem per se in terms of the options to be able to produce the energy that is required. Naturally, we have to find ways and means of making that energy production cost effective. Otherwise, we are not going to be able to pay.
It makes no sense.
It makes no sense, and we might as well rely on cloud services from those who are producing energy cheaper. But there are the opportunities and options to do that. The problem is that many of the conversations around energy production in the region and renewable energy development and integration remains at a power sector level and is just looking at power demand based on existing models of demand forecasting, where you simply take the economic growth, projected economic growth of a country that is coming from the IMF based on the standard, economic model. And then you will look at it in a standard power generation expansion model and say, okay, this is where we are now. We expect growth to be 5% per annum for the next 10 years, and therefore this is how much power we'll need. So it's looking at it through very, very standard lens. So the principle of understanding how the world and this is innovating around us and figuring out how the power demand is going to change, the forecast is going to change based on the new paradigm is not something that we have done well. And thinking about how, look at the coupling of sectors is still a challenge. There is still an apathy, and many of the people in the power sector are still very traditionalist, very conservative. And there's, and many in the banking sector, unfortunately, are also like that. And so if you're a power sector traditionalists and your banking sector traditionalists are lock in step and say, look, we need to see the growth clearly laid out before us before we can start to think about projects that would support. They are not into the build it and they will come kind of model. They are into, we have to see it first before we will put a dollar in it. And that is the thing. St. Kitts and Nevis is a perfect case in point, because that's an area a country I'm involved in with a lot of work there. And the principle at Nevis as an island is in the process of thinking of and actively working towards developing 50 megawatts of geothermal power and as much as 45 megawatts of solar PV power complemented with battery storage, which means you're looking at probably up to 100 megawatts of renewable energy over the next decade in an island that currently has a peak demand of 11 megawatts. People are laughing and saying this is nonsense. Because they are looking, when they view through traditional lens, where on earth will Nevis get the demand to be able to use 100 megawatts of energy? Those are the kind of conversations that are discouraging the decision makers from continuing to do the development at the speed which is necessary for us to have the kind of readiness, because nobody is looking at what we call demand building activities. So when they start demand building activities like, as you said, data centers and hydrogen power generation. And they say, all these are pipe dreams and these are pies in the skies. These will, we are not never going to get there in the Caribbean. So why are we wasting time and money on these things? Let's just build some solar to meet the domestic demand. Let's just build some geothermal to meet the domestic demand and not waste time on these things like trying to build oversize the capacity so that you can generate some to transmit to other countries through inter-island cables, whether underground or overhead. Those kind of things. People are looking at them and laughing at them and say they are pipe dreams. And, these are the things that are holding us back because we are not prepared. Many of us are not prepared to make decisions that are innovative. And in instances, those who are prepared to do so are being held back by the trappings of those who have influence and are advising those who are decision makers not to go with the things that are unconventional and novel.
Waste of time. I tell you sometimes, but Devon, we have 1 minute left in this conversation. And if you, from where you sit, can you give me probably 2 or 3 strategic recommendations that you would offer to the governments of this region over the next 24 months to really transition this region to the next level in terms of electricity and in fact the whole power space?
Yeah, well, the first recommendation is sector coupling. We need to stop looking at power through just an electricity sector lens. We have to look at it across what we call a multi-sector lens. Look at things like data, look at, and ICT, look at things like hydrogen and electrochemicals as a replacement for petrochemicals, and look at it as a part of a green industrialization. So move beyond just to look at power through the conventional expansion arrangements that seek to meet the existing domestic demand and grow incrementally. Otherwise, we will continue to grow incrementally as countries. And the second is, we have to really try to use those, if you want to call it, use the existing infrastructure, let me call it financial instruments that are available to us globally to prepare ourselves, because there's a lot of financial instruments out there globally that can help us to do. But we tend to only focus those instruments on what with the tried, tested, and proven, and if you want to call it the basic needs. So we are quick to use most of the CDB money and the World Bank money and the IDB money and healthcare and schools and so on. We understand and agree that these things are important, and basic needs and infrastructure for healthcare, education, roads and so on, water and so on are critical, but we must always find ways and means. We have to always find ways and means of putting something in it for innovation and for the futuristic development that will move us from the incremental changes to the real sustainable changes. And finally, the issue of planning and is one that we still need to spend more time on. The issue of integrated planning, we still haven't got there yet. We do integrated planning on paper, but we really haven't made it a way of life.
Yeah. All right. Well, Devon Gardner, Senior Partner at the Institute for Innovation and Growth, I thank you very much for your time today, sir. And we hope that we'll be able to have further conversations as these things evolve over time. So thank you very much.
Thank you, sir. Have a good day.
In a world of constant change, insight is your greatest asset. At Joseph Cox & Associates, we empower innovation across the Caribbean. Whatever your challenge, we can help. We're proudly customer-centric, offering bespoke solutions tailored to every partner. From innovation and digital transformation to leadership and policy, our services are designed to deliver lasting impact. We partner with leaders across sectors, from finance and government to energy, tech, and infrastructure, helping them navigate complexity with confidence. Our work is grounded in collaboration. We connect regional leaders through powerful networks, driving change through joint research. Discover more at josephcox.org. Joseph Cox & Associates. Insight, experience, impact.
Hello and welcome to Market Watch, your essential roundup of regional business news. I'm Joseph Cox. We begin in the Bahamas, where CAF has approved a $100 million loan to support energy sector reforms. It's the country's first sovereign financing since joining CAF, as Nassau seeks to modernize infrastructure and pivot to renewables. Meanwhile, the National Insurance Board has launched a compliance crackdown to address a projected $32 million deficit, and tourism earnings remain constrained by limited stopover capacity. In Jamaica, major shifts are underway. The government will not renew JPS Co's license in 2027, signaling an end to the electricity monopoly. Tourism rebounded in Q2, buoyed by a new airlift and regional travel. The Bank of Jamaica held rates steady at 5.75%, citing contained inflation, while customs reported 80% compliance with WTO trade reforms. And with $200 million in upgrades planned for Norman Manley and Sangster International airports, the country is betting big on infrastructure. In Trinidad and Tobago, they saw a modest oil recovery in Q1, but gas and petrochemical output slipped. Still, the private sector is buzzing. Medcor's IPO was fully subscribed, with its SME market debut set for July 7. Prestige Holdings posted a 46% jump in profit. The board declared a dividend even as Agostini Limited launched a takeover bid. Meanwhile, lithium-ion battery imports will remain duty-free until 2027 in Trinidad, supporting the push for 30% renewable energy by decade's end. Barbados is holding steady. Q1 growth reached 4.9%, driven by tourism and construction. The country surpassed its fiscal surplus target, bringing public debt to 115.6% of GDP. NewCAF full membership also unlocks greater access to development finance, while the Blue-Green Bank initiative gains momentum. Across the Eastern Caribbean, Grenada's debt to GDP fell to 71.3% despite hurricane-related pressures. The EC posted a record $126 million profit, fueled by reserve earnings. Antigua's inflation eased to 4.3%, and St. Lucia has launched a national land bank system to streamline agriculture leasing and expand access for youth. In Cayman, a new minimum wage will take effect in 2026, and non-Caymanian civil servants will face new 9-year term limits, aligning public sector rules with immigration policy. However, tourism may face headwinds as cruise arrivals dipped 20% year-on-year in Q2. Bermuda continues to dominate in reinsurance, holding over 60% of U.S. life and annuity transactions. It also became the first Caribbean jurisdiction with full 5G plus mobile coverage. Meanwhile, the region is adjusting to new global tax dynamics. A G7 carve-out shielding U.S. multinationals from OECD minimum tax rules has raised concerns about fairness and future investment, especially for early compliance states like Barbados, Jamaica, and Bermuda. In consumer news, St. Kitts and Nevis is offering 90 days of tax relief on school supplies, while CARICOM has approved a 35% tariff on paint and varnishes effective July 2026. Tropical Battery, despite plunging earnings, is pushing ahead with its public share offering to manage acquisition-related debt. Also, Carib Cement has launched a $42 million plant upgrade to cut imports and boost production. And finally, let's check in on currency movements and regional markets. On the currency front, the Jamaican dollar trades at $160.77 to the US dollar, while Trinidad and Tobago dollar sits at $6.76. The Bahamian dollar holds firm at parity, and Guyana's dollar remains one of the region's weakest at $218 to the US dollar. In the Caribbean stock market, Jamaica's JSC index gained 0.69%, closing at 312,991 points. The All-TNT index climbed 1.3%, while the TTSC SME index surged nearly 5%. Meanwhile, Bermuda's BSX index fell 3.65%, and the Eastern Caribbean's ECSC edged down by 0.08%. Top gainers included Epley Caribbean Property up 14.3% and Ansa McCall rising 11.5%. On the flip side, Epley Limited dropped almost 11% and West Indies Tobacco slipped 2.2%. So that's it for this edition of Market Watch, I'm Joseph Cox. Stay tuned for Global Pulse, which comes up next. This is CBR. Welcome to Global Pulse. I'm Joseph Cox. We begin in the United States, where trade policy continues to dominate headlines. The controversial Big Beautiful Act is now law, and the legislation, which extends the 2017 tax cuts, slashes Medicaid, and repeals student loan forgiveness, is projected to add trillions to the federal deficit over the next decade. Simultaneous to the U.S.-Vietnam trade deal imposes a 20% tariff on Vietnamese imports and even steeper penalties, 40%, on transshipped goods. These moves reflect a hardline stance as President Trump's 90-day tariff reprieve nears expiry. Still on trade, Maersk reports that U.S. import tariffs per container dropped to 21% in June, down from April's 54% peak. This comes as global shippers race to finalize deals before the July 9 deadline, aiming to avoid a fresh wave of tariffs. Meanwhile, U.S. manufacturing remains in contraction, job growth is slowing, and the private sector lost momentum in June. Turning to Europe, UK's GDP grew 0.7% in Q1, bolstered by services and net trade. But a troubling trend is emerging. Entry-level job vacancies have plunged nearly 32% since late 2022, with AI-linked automation reshaping employment pathways for young workers. On the regulatory front, the UK is tightening steel safeguards and will ease anti-money laundering rules for professional firms by year-end, seeking to balance risk and competitiveness. In the Eurozone, German inflation has cooled to 2%, finally aligning with the ECB's target. With energy prices falling and core inflation stabilizing, markets are now eyeing a possible rate cut in September. Meanwhile, Ireland's central bank is urging urgent tax reform and long-term fiscal discipline, warning of a €165 billion spending gap by 2050, driven by housing, aging, and climate needs. Across the Atlantic, Canada has walked back its planned 3% digital tax on U.S. tech giants to salvage trade talks. Gold exports surged 30% in May, helping to narrow the country's trade deficit, even as exports to the U.S. slipped for a fourth straight month. In Asia, China is offering a 10% corporate tax credit for foreign investors who reinvest dividends in priority industries, while the U.S. has recently lifted export restrictions on chip design software, calming tech tensions for now, but tensions elsewhere are rising. South Korea's exports dipped in the first half of 2025, dragged by falling shipments to the U.S. and China. And in Pakistan, tax revenue rose a record 42%, driven by new digitization and enforcement tools. Finally, in the commodities market, HSBC has raised its gold price forecast to $3,215 per ounce, citing rising U.S. debt and geopolitical risks, and reflecting its enduring safe haven appeal. And in energy, OPEC Plus is set to increase oil output by over 400,000 barrels per day in August, pushing total hikes this year to 1.78 million. Members like the UAE and Russia are leading the surge as the alliance claws back market share amid shifting geopolitical sands. Before we close, let's take a quick look at energy futures and global markets. Over in commodities, oil prices declined, with West Texas Intermediate crude falling to $6.50 per barrel and Brent down to $68.30. But the OPEC basket rose 1.5% to $69.79, signaling support amid production adjustments. Natural gas also eased to $3.39. Shifting to the markets, Wall Street posted solid gains while the Nasdaq leading the charge, up 1.02% to 20,601 points. The S&P 500 climbed 0.83% and the Dow Jones rose 344 points. In Asia, Japan's Nikkei edged up slightly while Hong Kong's Hang Seng fell 0.64%. In Europe, markets slipped. Germany's DAX dropped 0.61%, France's CAC 40 lost 0.75%, and London's FTSE 100 was flat. Now that's your global pulse for this week. Stay informed with the Caribbean Business Review, and this is indeed CBR. Okay, that's a wrap, folks. Thank you so much for your attention on today's Caribbean Business Review. We had what I would think was a rather interesting conversation with Dr. Gardner, where we looked at the issues of a couple of takeaways from it. One, the JPS does have obligations until 2027 that they are obliged to fulfill. Two, the region really needs to be looking at our future energy demands, and particularly within the context of the emerging AI industry, which we all know is very power hungry, right? It's electricity hungry, so we have to pay particular attention to that. And of course, looking at the expansion of our region, our economies, etc., etc. We also have to take, what we also took from the conversation is that there are serious lessons to be learned to avoid some of the pitfalls or some of the nationalization pitfalls that obtain with some of our Caribbean partners, our Caribbean countries. So therefore, that their experiences have become part of the guidelines of how to treat with some of these issues. Even though government of Jamaica has indicated that it has no intention of nationalization, the fact of life is that there are other countries around this region who are faced with similar issues with their the electric utilities and maybe exploring all sorts of options. So all ideas contained at this stage. We, of course, as we closed out that interview, what really came to the table was that performance-based regulations should be the way to go as we start to look at the new emerging platforms for us to expand and increase not just the efficiency of our electricity supply across the region, but frankly the cost, because our costs are indeed among the highest in the world. So we have to look at these things as a matter of urgency. Now, that being said, just want to advise that a brand new issue of the Caribbean Financial Dispatch is now available. And as per usual, if you wish to avail yourself of that, you can simply log on to josephcox.org and look for the CBR page, and you'll be able to access it there. For those who do not wish to do that, you can also send us a quick email at caribbeanbusinessreview@gmail.com for us to put you on the subscription listing and transmit the documentation to you. We also want to personally thank the people on TikTok, because they have really, really been very responsive to our very recently opened account. And we just hope that we'll be able to grow from strength to strength as we broaden and deepen the offerings coming out of the Caribbean Business Review. So we also want to extend our thanks to listeners at MKR Radio for continuing to engage with us and, of course, your positive feedback. Now, ladies and gentlemen, just to remind you that you can access us on Spotify, of course, on LinkedIn, here on the YouTube channel, and of course, the rest of social media offerings that are on the table. Because the fact of life is that what we are seeking to do and what we intend to do is continue to broaden and deepen the base of this program so that we will be able to really, really help drive decision making as you go to your offices in the mornings or you come from work in the evenings. We are there with you and guiding you with a fact-based, data-driven, data-centric offering. So until next week, God's willing, same time, same place, I'm Joseph Cox, and this has been CBR.